The Bloomburg reporters found similar patterns across the country. When there's a disaster, they found the companies that homeowners count on to make them whole again frequently pay less than what the homeowners think their policies promise, even when homeowners say they had firm assurance from their agents that they were fully covered.
People basically were offered a lot less than what they deserved. It's like calling 911 and getting hung up on.
Meanwhile, the industry's overall profits have been soaring. Even in 2005, with Hurricane Katrina becoming the costliest disaster in American history, insurers reported record profits of $47 billion. Then last year, the industry racked up its highest profit ever of $67 billion.
The profits are enormous at a time when they're continuing to put pressure on people to accept lower amounts of money.
How did this happen? Well, consider one factor. In the early 1990s, Allstate Insurance hired an influential New York-based consulting company. McKinsey & Company works with businesses to figure out ways to make more money. McKinsey began advising Allstate Insurance to hold down costs by changing the way it dealt with policyholders. To this day, the McKinsey documents are a closely guarded secret. But David Berardinelli, a Santa Fe, New Mexico attorney, managed to get a hold of them.
The documents that we discussed.
Berardinelli makes his living suing insurance companies. And 6 years ago, during an accident case unrelated to the California fire, he gained access to more than 12,000 pages of documents McKinsey provided to Allstate in the early 90s. He's been fighting to use the documents in court ever since. Why does Allstate work so hard to keep this information out of public view?
It would be a public relations disaster, because it is, when you strip away all of the fancy wording and all of the insurance company jargon, simply a plan to transfer money from the pockets of policyholders into the pockets of shareholders and top executive management.
Berardinelli had to return the documents to Allstate in the course of his case, but he took copious notes, and using these notes, he was able to show us what a jury has never seen, his recreations and excerpts of McKinsey's advice to Allstate. So on the slide here, zero-sum economic game, it reads, Allstate gains, others must lose. These are the words of who? The consultant?
These are McKinsey's words.
To Allstate.
To Allstate.
He said McKinsey was emphasizing the point that if Allstate was too generous to its policyholders, there'd be less money left for its shareholders. That's the zero-sum game, he says.
This is a very popular business term. It means, in essence, that to make money in business, you have to take it away from somebody else. Now, that's okay for IBM or GE or Intel. But the problem is that insurance is not a regular business. You're taking people's money on a promise, and you're promising to pay it out at a later time.
I know what happens to people at those moments. I know they can be frozen with fear.
It's quite a different picture than the one painted by the company. For 57 years, Allstate has advertised itself as the good hands people.
You're in good hands with Allstate.
Berardinelli says McKinsey also used the term good hands on a slide showing how to settle claims. It suggests that 90% of customers should get the good hands treatment, but if they don't settle quickly, the other 10% should get boxing gloves. You see this term, boxing gloves. Is that your term?
No. That's the term that was used by McKinsey.
No longer good hands, but put on the boxing gloves is the idea.
That's correct. If you want full payment, you're going to get boxing gloves. That means years of drawn-out, no compromise, mad dog litigation.
David Thiefeld's been fighting Allstate to rebuild his two-bedroom, two-bath home lost in that California fire. He says he's seen those boxing gloves in action.
Deny, delay, and defend. The main one you experience is delay. You know, they want documents of everything. They want as many photos as you can find, videos you can find, who gave you an estimate for hauling away debris, who gave you an engineering estimate, and then they subpoena all those people. And And then they cancel their appointment with them, and then they reschedule them, and then they cancel it again, and then they reschedule it. And they just drag it and drag it and drag it and drag it until you're almost 4 years out.
Last month, after nearly 3 years of battle, Fiefeld settled for $112,000. That's $56,000 less than Allstate originally offered, and nearly $250,000 less than his contractor told him he needs for rebuilding. But he felt victory in court was far from certain, and he realized he would lose financially even if he won.
It would have been a wash because the attorneys would have cost so much. And then if it were to have lost, well, then Allstate's attorneys is going to come after whatever value is left in me, which for me is the lot here. So, stuck.
What would be the point of spending so much money to fight a smaller claim?
To set an example, to let other people know that if you challenge our values, we will spend obscene amounts of money to crush you.
A number of Berardinelli's slides dealt specifically with how to be tough in lawsuits. One advised many plaintiff attorneys yield to more aggressive tactics. Another recommended stand firm on final offer with no real negotiation. From the point of view of a guy who sues insurance companies for a living, these are fighting words. You have a financial interest in reading into the original consultant's documents a negative intent. I mean, you're a lawyer who represents people who feel they haven't gotten what is due to them. Didn't that color your perception?
I think the slides speak for themselves. A good hands to boxing gloves style of claim handling is not something I made up. If you have a positive interpretation, I would be